We are live. Welcome
Right.
to our weekly basic income discussion group. I'm Alex Howlett. I host these things. Each week we have a different topic, and today's topic is Fed accounts. So the idea of individual people having checking accounts at the Fed in lieu of kind of everyone finding a checking account at their own bank, that kind of thing. So there's this guy, Morgan Ricks, who has proposed this, and he's written a paper about it. And some of us listen to a podcast episode where they talk about it, and it's only 9 minutes and 25 seconds long, so we'll make our way through it during the discussion. But before we do that, I just want to ask people what they think about the idea of everybody having a free bank account at the central bank, and whether those thoughts change in the presence of something like a basic income. Is it something that would be great to have even if we don't have a basic income, that kind of thing?
I guess I don't have a lot to say about this one yet, so I'm looking forward to talking about it. I guess the little bit that I do know suggests that there are some barriers to getting bank accounts that can be important for people. Mm-hmm. So I guess the idea here would be that you maybe wouldn't have fees or minimum deposits or things like this. I guess with a basic income, there's some ways that it could be less important, which is to say that people might be more likely to have the money to pay fees, or banks might not care that much because they know they have a steady stream of money. But at the same time, maybe it would be efficient in a different way if you wanted everyone to just have this account automatically, and that's where the basic income was deposited. Imagine it was done maybe through the government or something like that. Then I guess I could see that being useful in a different way. So.
Yeah.
I guess I don't really know the drawbacks to it either, so I'd be interested in those.
Yeah. Okay. Mom?
Yeah, I would say the same thing. I mean, for basic income, it'd probably be more efficient, to have one central place. But I actually don't understand why we don't have it now. What the reasoning is, what the origin of bank accounts comes from in the first place. So It's hard to know why we're not doing it now. There must be reasons why. I just don't know what they are. I'm interested to find out what they are. It can't just be minimum fees and that sort of thing are drawbacks.
It's a really good question, and we'll be getting into that definitely.
Okay.
Yeah. Elizabeth?
I also don't have a lot of thoughts about this. In part, I didn't listen to the podcast, so I read the brief article, and I was this is not super helpful to me.
Okay.
So I think similar to Bethany. I mean, it seems if you're going to start distributing basic income, it would make sense to then give everyone a bank account that you can put those into, and then I don't know enough about how it would work to be then the people naturally migrate to other banking systems once those banks are okay, we know that you have a consistent flow of income, and so now we want your business. Are there inefficiencies if you create a bank account for everyone and put the basic income in that, and everyone else, and 90% of people are but my primary bank account is somewhere else? Are those inefficiencies that would come up? Because it seems you would want to just pick one system and not be well, we're going to try to take the unbanked people and give them bank accounts, because that feels a different kind of inefficiency to try to capture all of that. But,
Sure. Richard?
Well, having separate bank accounts for each tier of people, if you will, the 7%, well, that might become stigma. You have a Fed account, and we have a regular bank account. So with the basic income, if you don't have a basic income, and it goes to welfare people or something, it'd be something like that. Banks, they started out with the Middle Ages in Italy, and there was the Knights Templar. They were the first international bank, and so they took 10%. And they give you a coupon or something like that, and they would put a wax seal on it, and then we'll take 10%, and then you can go to this bank in say Palestine, and you can get all your gold but those 10%, and then you can buy things there.
Right, so it's a money-making thing for the banks, but the Knights of Templar, I never knew what they were doing.
The Knights of Templar, they were the first international bank, and
never knew that.
And that's one of the reasons that there was a raid on their headquarters, and Friday the 13th, And that's why it's one of the reasons why it's a unlucky day, supposedly.
Really? Huh.
Never heard that before.
Interesting.
And the king of France and the other kings were jealous of them, so they took them down over a few weeks.
Wow.
Cool. Steve.
Well, we know that the government can manage Social Security, so it can take money in and save money and put money out. And that's what the Fed accounts would be doing, so I have confidence that they could make Fed accounts work.
Yeah. I think it's a really cool idea. I think there is some truth to the idea that if you're paying everyone a basic income, eventually the problem of how to distribute it to people will take care of itself, because then everyone knows that people have access to basic income if you give them access to banking and all of that. So I think Bethany made that point, and I think that's a good point. But it's also it would be a really simple and efficient way to distribute it. And if you're in somewhere like the United States, you don't have to worry about these problems in Africa, that we talked about, of like the last mile problem of how you transport the basic income to people.
Do other countries have their own like Fed accounts, and that's where or is that just a proposal for the U.S.?
I'm not aware of any countries that do this. This proposal is for the U.S., but it feels like it's such an intuitive idea that I think it's worth asking the question, or we should maybe look into whether there are other countries that do this kind of thing, or ask why it's not being done. And I have some ideas, and they have partly to do with why we have banks. So we've had banks in the United States for longer than we've had a central bank. So to your question, Mom, about why we don't just automatically have accounts at the Fed, and why that isn't the default, is because there didn't used to be a central bank. So part of it is historical, that the banks would provide this service for people, and people were willing to pay for the service, or the banks could lend if they had enough reserves. They could lend and stuff like that and make money that way. So it's definitely like banks are in it for the money. They're doing it for profit.
Right.
And the Fed would not be.
Yeah, actually, Alexander Hamilton was a big proponent of the Federal Reserve and a Federal Reserve, and there was one from like the 1890s until 1830 when Andrew Jackson dismantled it, and then there wasn't one until in 1913 when it was signed in as a constitutional amendment.
Yeah, I think there was a first bank and a second bank, and then the Federal Reserve came in 1913 after many decades of not having a central bank of any kind in the United States.
So how did these banks that were scattered about, where did they get their reserves? How did they operate?
We actually did a discussion on this, and they were able to issue their own currencies. And
Each bank?
Yes, and they were backed by gold, and they were like wildcat banks where they can put their place out in the middle of nowhere, and you had these notes. You had to have. They could bring them back to the bank, and they could get gold out of them. So they had an incentive to print out as many notes as possible and have the least gold possible. But
Why?
so they can hit. They have most profit.
They want to be able to take more deposits and make more loans, because they make money on the loans, right? So they want to be able to do as much of that activity as possible. So if they can do more of that for the same amount
that they can't back up, though, then.
Well, that's what happened. A lot of them collapsed,
Right,
but a
that's
lot of
the
them tried to find ways to get around it, like Richard said, by being in the middle of nowhere, so no one could check to see if you actually had the gold and that kind of stuff.
Right.
But yeah, I mean, the basic idea is that they'd have some kind of capital backing up the reserve, so they'd be able to make promises like, we issue these notes, but if you come to us with these notes, we'll give you the gold, or we'll give you whatever's backing up the notes.
And what sort of people started banks? I mean, where did they get the capital?
So they were people who already had money, and they wanted to.
So it started with wealthy people, really.
Well, yeah, I mean, it came from. So there were kind of two groups of people that wanted something. So lenders wanted to lend out their money and use their money to make more money, right? So people who had money wanted that. And then there are other people who, had some money and they didn't want to like carry around gold and or manage it directly. So they'd put it in the bank, trusting the promise that they could get money out when they brought in their notes or
And well, the term bankrupt, that's actually from Italy, and it's the bonk is like bench, and like rupture or whatever went under or whatever.
Ruptured bank. I never knew that.
Yeah, bank
Oh,
comes from
interesting.
the word for bench.
Oh, interesting.
Because there'd be like the bench.
There's a money changer.
Yeah.
Well, like
The money
bench.
changer bench. Yeah.
Oh, really?
Yeah.
How interesting.
Like they had all these coins. You know how in the old movies they like bite the coin to see how
Yeah,
the metal
yeah,
comes
yeah,
in?
yeah.
That's what the money changers did.
Yeah.
Yeah, interesting.
So anyway, yeah, I mean, like, and it's interesting because the way the current system works is you've got an entire financial system that is supported by these banks.
Right.
And if you introduced Fed accounts and people moved their deposits over to Fed accounts, now the reserves from the banks would get drained and they would no longer be able to lend and invest anything because they wouldn't have enough reserves to
Why
back
would
it
they
up.
get drained?
Because if you have an account at, say Bank of America right now,
Yeah.
let's say there's now a Fed account that opens up and it's got, no fees, no minimum
Right.
balance.
So people
And
just move
your
their
basic
money.
income goes in there maybe.
Right.
So you'd move all your money into your Fed account. That
Right.
drains the reserves out of Bank of America.
Right.
Because when you move your money, your bank has to send those reserves to another bank.
On another note,
Yeah.
the funds are usually backed up by the Fed, right?
So there's the FDIC, which is the Federal Deposit Insurance Corporation, and that's if your bank fails, then they'll come in and pay out your deposits.
To the federal bank.
That came out.
That's the FDIC is a different institution from the Federal Reserve. They're both kind of independent government institutions created by Congress for different purposes.
Yep, like they'll run on the bank in the 30s.
Right.
Yeah.
So right.
Yeah,
So the
and
Fed
then came after that so that you could
the Fed
know that your funds were insured.
right. So the Fed was created in 1913, and then the FDIC was created after the Great Depression.
Okay.
Yeah, or during the Great Depression.
Right.
Yeah. Yeah. But that's also an interesting point because if people have accounts at the Fed, you don't need to insure those accounts because they're at the Fed.
Right.
So you don't need the FDIC to back up Fed accounts.
Right.
And then, that brings up that prompts the question, do you need the FDIC at all? Because if everybody has the option of having a risk-free deposit account at the Fed, a checking account at the Fed, then why do we need to insure these other banks?
Why is it risk-free? Why is it risk-free if it's at the Fed?
Well, the Fed can't run out of money.
They just make more money. You mean?
Well, yeah, literally deposits at the Fed are base money in our economy.
Right.
That's what, so when
It backs up the other banks.
when banks have reserves, like it used to be gold.
Right.
Now it's deposits at the Fed.
Right.
So what we're talking about here is giving everybody deposits at the Fed.
Right.
So that's like the purest, highest form of money is the deposits at the Fed. You don't withdraw it for something. You just transfer it to other people's accounts. You spend it, right?
And that would get rid of the FDIC, which is also problematical. It's always problematical to get rid of an institution that exists and,
Right.
has a reason to be it makes money, I assume, and
I mean, it's part of the government, so it's not like its role is not to earn profit or something like that.
There are people who have a stake in keeping it.
Well, there are people who
going,
have
I'm
jobs, in that. Yeah. So if you didn't have, if banks were no longer backed up by the FDIC, what we think of as traditional banks were no longer backed up by the FDIC, then you'd really need a reason to put your money in there instead of in your Fed account.
Like it would pay more interest or something.
So the banks would have to first convince you that they're fairly safe and they've got enough capital backing up everything, enough reserves backing up everything, and then they also need to incentivize you in some way to put your deposits there, like saying, well, you're going to earn this amount of interest, et cetera, that kind of thing.
Kind of like money market accounts do now.
Kind of like how money
Or like
market accounts do.
savings accounts, yeah.
Are money market accounts insured? I think they might be, yeah. But yeah, I mean, I would imagine that if you have other deposit-like accounts, which we actually do today, like money market accounts, and there are various, accounts like that have something that's kind of close to a deposit, but it's not actually a federally insured deposit. So you'd have that kind of stuff still, and it'd be interesting to see how it shakes out. One thing, we can start listening to this in a second, but one thing that's interesting is that he talks about, at least in his paper, he talks about how it would make monetary policy simpler. So, and he talks about how the Fed is like a bank, but for banks. Mm-hmm. So you don't have a deposit account at the Fed, but banks have deposit accounts at the Fed. And that, like I was saying, that's what they use as reserves. Mm-hmm. The Fed pays interest on those reserves. So the banks get, I don't know, something like 1.25% interest on just the reserves that they hold.
1.95, it said in the article.
Oh, 1.95? Mm-hmm. That doesn't sound, I mean, the article is not super up to date.
Almost a year ago.
Almost a year ago, yeah. So I don't know what the interest on reserves is now, but it's some amount, and it's much higher than kind of what you'd get on your checking account. So one of the arguments he makes is that, but if you do this, now everyone can kind of get that benefit. But I think part of the point that he's missing is that the reason the Fed pays interest on reserves isn't to provide a benefit to the banks. It's to influence monetary policy. It's to influence the interest rates in the overall market. So the reason they pay interest on reserves is because now you've got a floor on how much the banks are willing to lend out the reserves for. Because if I'm earning 1.95%.
Also, what the reason they have put money in the bank is so that the banks have some or make sure that they have enough to back up their loans.
Right. This is why banks need to hold reserves in general. But as it is now, since the financial crisis in 2008, banks have way more reserves than they need to actually back up their deposits. And this is something that changed in 2008. It wasn't like this before. Banks usually had exactly enough reserves, and they had investments and everything kind of balanced out. And then if they needed to make a new investment, they had to find reserves from somewhere or borrow reserves or something like that. And it was all very tight. Now banks are awash with excess reserves. And the reason, the reason for that is that the Federal Reserve, through their monetary policy, they want to limit the amount of lending in the private sector. So if they pay interest on the bank reserves, now if they pay, say, 1.95% interest on the bank reserves, the banks aren't going to lend that out for any rate below 1.95%.
You mean above 1.95%?
No, below. They'll lend it out if they make 2% or 3%, but they won't lend it out if they only make 1%, right? Yeah. So that's the reason why we're paying interest on reserves, and it's the reason why there are so many reserves in the banks right now.
Interesting. Because the interest rates are pretty high.
Because the interest on reserves is higher than what it would take for the banks to actually lend those reserves onto the market. So it used to be, before 2008, the Fed did not pay interest on reserves.
Really?
Yeah. This is new in 2008. They did not pay interest on reserves. Yeah.
But they still set interest rates with something else, right?
Yeah. So they would do that. So like I was saying, banks needed to borrow reserves from each other. So they would do a couple of things. They would, they do the main thing, which is called open market operations, where they would buy and sell treasury securities to the financial institutions and the banks and stuff. So if you buy treasury bills from the open market, from the banks, now those banks have more reserves because you're paying in reserves, right? So that way you can kind of control the amount of reserves. And then the other thing that happens at the same time is that if you're buying So naturally, if they have more reserves, you would expect the interest rates to go down because there's more reserves available. You don't have to pay as much to get reserves from other banks. And then this other effect is that now the price of the Treasury bills has gone up because there are fewer of them, because you bought them, right? So their price goes up, which means that the yield on them goes down, and that's an interest rate too. So you've got interest rates going down in a couple of different ways.
Interesting. So why wasn't that sufficient? Like, why add this other thing of paying money, like interest on reserves at the Fed?
Yes, and that was an interesting thing. It was it's partly related to the fact that they wanted to backstop the markets for various.
They want another Bear Stearns. They don't want another one.
Right. So when Bear Stearns collapsed, when Lehman Brothers collapsed, there were all these assets that financial institutions were holding on their balance sheet that collapsed in price, became worthless, or became worth a lot less. So what the Fed did, this was, it was kind of like a chain reaction, kind of a house of cards collapse type situation. So what the Fed realized they had to do was they had to start buying some of these assets and put a backstop on these assets. And by buying those assets, now, like I said, when you buy an asset and you're the Fed, you're paying in reserves. So now you're flooding the banks with reserves. So it's just kind of a side effect.
Buying assets.
So say that you lent some money to Bethany, and she owes you $10 million. So you've got a little note that says, $10 million I owe you from Bethany on such and such a date. Then you find out Bethany's bankrupt.
Oh no.
Now your note is not worth anything anymore, or it's not worth as much anymore because you can't get as much from Bethany. Now you owe someone some money somewhere, and you're not able to pay it. Their note is worth less, and it kind of like spreads throughout the economy.
Right.
So what the Fed did was it stepped in and said, "Oh, hey, you have that IOU from Bethany. We'll buy that from you."
I see.
So it kind of put a floor on the price of kind of the debt that was unable to be repaid.
Okay.
And now that you have actual reserves, you have something close to what the original value of that asset was. You're not going to default on your next loan or on the thing that you owe the next guy, right? So it kind of put a firewall on this kind of chain reaction collapse of things. Because if they hadn't done this, there would have been another Lehman Brothers or another Bear Stearns or something like that.
So was there like just this first layer of people that they had to give reserves to? I mean, how did they decide who got those?
Yeah, so they did a couple of things. First, they created the facilities because they didn't have a procedure for doing this before. So they said, okay, we've allocated so much money or we're allowed to do so much spending in the economy to buy up bad assets and backstop bad assets and stuff like that. And then they decided how to kind of distribute that, what kinds of things to bail out, that kind of stuff. Yeah. And it's actually really complicated. Like there's a lot of different ways in which they did this in a lot of different facilities. But the end result of all of this is that the banks were kind of flooded with reserves, but they didn't want interest rates to get too low, or they didn't want all of that money to just go flooding out into the market. So they wanted to backstop these assets on one level, but they didn't want too much lending at another level. So then they started paying interest on reserves. So that's kind of the story. Yeah. I'm not saying it all happened as cleanly as that or in that order or something like that, but that's kind of a way to think about what happened. There are some people who argue that this is bad. They don't want the Fed paying interest on reserves, and because there are so many reserves out there, the Fed is also holding all kinds of Treasury securities and other assets on their balance sheet. So their balance sheet is like 4 times or something the size it was before 2008. That number might not be right, but it's huge now. And there are people who are arguing that we should shrink it back down because I don't know that it would really be more efficient to shrink it back down. I think it's fine to have the balance sheet at the size it is, but there are people who argue that you should shift it back down, shrink it back down, and that the reserves now that they're paying interest on serve the same role that Treasury bills had traditionally served, because a Treasury bill is an asset that pays interest, right? Now reserves are assets.
Well, that's what I was asking.
Interest,
it seems like
right?
There's more redundancy.
Yeah. So there are people who argue that we need to sell all these treasury bills back to the banks in exchange for the reserves and pay interest on the treasury bills instead of the reserves.
Kind of like go back to how it was before.
Right. But that, of course, if you're selling treasury bills, that drives up the yield of treasury bills, and there are some complications with that. So they have mechanisms to kind of like counteract that. You know, what the government should be doing, should the government be, well, I guess one of the things they suggest that the government do is that they buy back long-term debt. And so long-term debt is like notes and bonds and stuff like that. So bill is short-term, note is medium, and bond is long-term. That's just kind of the terminology. So what they're arguing is that there are some people who argue that and I think we've talked about this before, that the Treasury should buy back the notes and the bonds and then issue Treasury bills instead that can then go to the banks. And now the total amount of debt outstanding for the United States government stays the same. They've just changed the maturity of it. And there's an argument that you can use that to then just replace all the reserves in the banks with treasury bills, all the excess reserves with treasury bills, and now you've shrunk the balance sheet of the Federal Reserve back down. So that was kind of a tangent.
But I want to say that now that there's all these reserves, as a response to the 2008 crisis, does that have any bearing on preventing a crisis now? I mean, is there any kind of, is that a margin or a buffer of safety that, no?
It's really kind of irrelevant. It's just kind of the state that we ended up in.
Yeah.
But it's funny because it's really a monetary policy thing. It's not like, oh, the banks are getting some kind of benefit and then there's this injustice. Other people should be getting this benefit too, which is kind of what he argues a little bit in his piece.
Right.
It's just,
a way to control lending.
It's just a way to influence interest rates. Yeah.
Can I say, so I wonder then in terms of like bank accounts at the Fed, if a lot more banking moved to the Fed, would it be different how they would need to control the amount of lending? Like, I guess I'm trying to put that together with how like monetary policy works. Yeah,
so it's an interesting question. What you really want to do is, I think paying higher interest on everybody's personal checking account, that sounds nice, but also you could just do a basic income and that sounds even nicer. And it doesn't depend, it isn't like proportional to the amount of money you have in your account, which is not exactly. You could just think of that as I guess one thing you could do directly then is like if you wanted to incentivize or not personal individual saving, then the amount of interest you pay on the Fed bank accounts was.
At banks, the more money you have in them, the higher interest rate they pay you typically.
Right. So that would not be true in the Fed accounts proposal for the Fed accounts. But it's a question of how do you make sure there's enough lending from the private financials sector once you no longer have this layer of commercial banks, doing loans and stuff like that. Or like, how do you get them to do loans if they don't have deposits on the other side? So maybe one more point I would make there is like, if you wanted there to be some private banking with loans, you might not want to offer particularly high interest rates in the Fed accounts. Like what this guy's suggesting might actually be not so great because, like, for example, right now you might have money in a money market account because it's 2%, whereas your bank account is like point-something percent. Yeah. I think the general mechanism is still true. You want to offer a lower interest rate if you want more lending. Right. But the level of the interest rate that would make sense for, a stable economy with the right amount of lending in it might be much lower once you implement the Fed account. It wouldn't be the current amount that banks are getting from the Fed.
Right. What's the right amount of lending? Why is there a right amount?
So we talk about this a lot. It has to do with there being the right amount of investment in businesses investing in building out capacity and stuff like that, and it has to do with having the right level of spending in the economy. Like, how are we getting the most benefit out of what the economy is capable of producing?
There's an argument that the Federal Reserve wants to have between 2 and 3% inflation per year. But if you have like a Fed account with a basic income, you could just provide more or less basic income to automatically adjust the amount of inflation in the economy.
Yeah, I'm a little bit wary of using something like basic income to try to to try to keep prices stable, that kind of thing. I think generally speaking, yeah, you want to kind of calibrate basic income to the level the economy can handle. But for more like fluctuations and stuff like that, I would still probably want to use monetary policy, because then you're not like, I think psychologically people would be, and it might be disruptive to the markets if people's basic income was volatile. If it gradually increased over time as the economy became more productive, that would be fine.
But you can, and Alaska's basic income is rather volatile. It's between 1,000 and 2,000, and it doesn't seem to affect their state economy that much. They can have a minimum and the sky's the limit for the federal basic income.
The question is, I mean, like, obviously Alaska has their system. I would say that it's not ideal that it fluctuates like that, but it's certainly better than not paying people any money. And then the question is, what is the optimal system for managing inflation? It's not a question of whether we could deal with it. We could probably deal with our basic incomes fluctuating a little bit. It's a question of whether it's better than maybe reducing the amount of lending or that kind of stuff. You know what I mean? Yeah. And my feeling is that you wouldn't really want to reduce the amount of basic income unless there was like a huge hit to the productive capacity of the economy or something like that. If it's mostly financial stuff, then, and there's no like changes in the real resources or something like that, then you should be able to handle it just using monetary policy. Yeah.
Well, there could be all the animals are fleeing the Yellowstone caldera region and that's highly unusual. So there could be a massive eruption soon there.
So if that happens, if we get a basic income, and then that happens, then maybe that's the time to reduce the amount of the basic income. But it's also true that if there's a sudden shock like that to the economy, that's going to be really disruptive, and maybe it's unclear to me whether reducing the amount of basic income would be better than just allowing all the prices to adjust one time to a new level of purchasing power based on the lower economic output. I don't know. I think generally speaking, you want prices to be stable and stuff like that. But if you already have a huge disruption, the question is, what's the least disruptive thing to do?
Right.
Yeah.
I say fill the caldera with money.
With what?
So that it flows out
money.
Yeah,
Money
exactly.
broadcast.
Exactly.
Money would be incinerated.
Yeah.
As a hedge, I guess.
Right, exactly.
Right, there you go.
Can I just?
Yeah, go ahead.
So if we were modulating the spending levels with the basic income, then the value of lending, back to like her question, would be mostly about investment in the economy, businesses growing and the economy growing and things like that.
Well, you can't really control what people borrow for. That's kind of hard to do.
I'm just saying that would be one of the benefits of making sure that you had enough
to lend.
Yeah, I mean, so investment isn't just about borrowing either. Like, you can if you already have money, you can invest the money you already have.
Right.
Borrowing could allow you to invest more, just like it could allow anyone to spend more than they otherwise would spend if they weren't borrowing. So I don't think there's a clear distinction between investment is for one thing and then basic income is for the other thing or something like that. Yeah.
But I guess I'm thinking of like, what can investment do that like basic income doesn't do?
I think it helps smooth things out. So no matter what, you're always going to have situations where people don't accurately predict, through no fault of their own, what their cash flows are going to be, that kind of thing, and then you can make up for it through borrowing, and that just smooths out.
In China, there are all these zombie corporations because their state-run banks loan out all this money to, the cement corporations and whatever. And
Right.
And there's all these inefficiencies in their economy.
Yeah.
Like with the Asian crisis, like 23 years ago, I guess it is now. Right.
Yeah, I guess we talk about that side a lot, like too much investment into the level of useless things. Yeah.
Right.
I have a question about the interest rate and how is it related to the prime rate? Is that a different thing?
So the prime rate is like for mortgages, or usually
Yeah.
that's when they talk about prime. So that's just a
Right.
normal, like, you've got good credit and you get a.
What's the rate that's set by the Fed?
So
the prime rate was too.
no, not directly. No, the specifically what the Fed targets is something called the Fed funds rate, which is the rate that banks pay to each other
Right.
to borrow reserves from each other.
Right.
So that rate is going to be lower than most of the interest rates you see in the economy. It's going to be lower than credit cards. It's going to be
Right.
lower than mortgages. It's going to be lower than treasury bills and that kind of stuff.
Right.
But in doing that, in influencing that interest rate, since it affects a lot of different things, that can have like a transmission effect to other interest rates in the economy. So when the Fed raises rates, that'll trickle up to the other interest rates, like the prime mortgage rate and that kind of thing. Yeah. But there is some argument that targeting the Fed funds rate is not particularly meaningful these days because banks aren't really borrowing reserves from each other because they have so many excess reserves.
Right.
So since 2008, it hasn't really made that much sense that is the rate they talk about targeting. They could instead just say we are changing the interest on reserves, and that affects the interest rates throughout the rest of the economy because it's not really through the Fed funds rate anymore that monetary policy is happening.
But that Fed rate is the one that whoever it is.
It's the one that they announce and
Yeah,
quote, and
they announce,
like Jerome
yeah,
Powell
okay.
will say, like, "Oh,
Yeah.
we're keeping rates steady."
Right.
That's the rate
That
they're talking
everybody-
about.
Okay.
But it's not a rate that is particularly meaningful. I
Yeah.
think the rate that's meaningful is the interest on reserves, which kind of ends up being a similar rate anyway. The actual Fed funds rate tends to be a little bit below the interest on reserves, I think, for various.
And how does that get set?
How does what get set?
Fed funds rate.
Oh, they literally say, "Oh, how does the Fed
They
funds?"
just decide?
No, how does the Fed funds rate
Yeah.
get set? So historically, the way it typically worked is banks only had enough reserves to do the amount of lending they were already doing. So if they wanted to lend more, they'd have to borrow reserves from other banks. So kind of like what I was saying before, when the Fed injects reserves into the system, that makes reserves more available and lowers the rate at which banks borrow from each other. So that's the rate they target. It's not a rate that they pay. It's a rate that they want banks to pay to each other.
And they do it by buying treasury securities?
They do it by buying treasury securities, and then that increases the amount of reserves in the system.
Okay.
Yeah.
Can't the regular banks be slowed down just by raising the fractional reserve, the fraction that they have to keep on hand?
Yes and no. If you're targeting if the Fed is targeting a specific interest rate, then and they change the fractional reserve, now they just have to do different open market operations to get to the same interest rate they were getting at before. So if they're targeting the interest rate, kind of the interest rate is all that matters. So if they doubled the reserve ratio, for example, now to achieve the same interest rate, they might have to double or vastly increase the amount of reserves that banks have or something like that.
Right, but I think he was just saying as an alternative kind of thing, like in theory.
As an alternative, instead of having a policy rate, you have a policy reserve ratio. Is that kind of what you're saying?
Well, just so the banks don't misbehave as much as they did in 2008, where they were leveraging at 40 to 1.
Yeah.
If they just were forced to keep 10%, 50% in reserve, it would make them behave better.
I think.
So ultimately, yeah. Do you want to?
I just want to say
one?
this. I think relates a lot to Joan's question before, too. Like with respect to could we have another crisis? Are we less likely to have another crisis now that the reserves are larger? Right.
Actually,
Right. So I think the answer is no, because essentially what you're doing, the banks are lending the amount they're lending because the Fed needs to keep prices stable. And in their goal of keeping prices stable, they've settled on a particular interest rate. So they're going to incentivize however much lending there's going to be. If you change the the reserve ratios, they still need the amount of spending in the economy to be what's consistent with stable prices. So it's not, I think that the banks had far, like individual banks, you can kind of point out, there's fraud here, or they're misbehaving here or doing something like that. But kind of in aggregate, it wasn't really the sum of all these banks being dishonest or over-lending or something like that. In aggregate, it was the result of monetary policy.
Actually, if you've
yeah.
heard of the savings and loan crisis in 1986, that was the result of the law changing for savings banks and credit unions, and they were able to loan out in ways that they weren't able to do before, and so as a result, they were inexperienced, and they defaulted and whatnot, and that started the whole too big to fail sort of thing, and that set the precedent for that allowed the banks to be bailed out in 2008.
Yeah. Yeah, and I mean, so kind of back to Steve's point, there are some people who argue for like full reserve banking and that kind of thing. And the important thing to remember when you go to full reserve banking is that now you've eliminated this mechanism in the economy of banks lending and borrowing and like expanding their balance sheets and that kind of thing, because their balance sheet needs to stay exactly corresponding to the reserves need to match the deposits, right? So if you put that regulation on banks, that would actually be similar to kind of what would happen if you had Fed accounts. But there would need to be, kind of like what I brought up earlier, there would still need to be somewhere in the economy some kind of financial institution that is not subject to these restrictions. So they could do the lending that the regular commercial banks are not allowed to do, or that the Fed typically wouldn't do, or that kind of thing. Yeah.
Well, it would be simplify things for me if there was Fed accounts, which is 100% reserve.
Yeah.
Sort of, what normal people think a bank is.
Right.
And then there was all the other banks, which are basically gambling, which is,
right.
I'd say, what they always were. They were, before 2008.
Right.
And you would at least know what you're getting involved in.
Yeah, you're taking a risk, and yeah, you could eliminate. Like I was saying, you could eliminate the FDIC and just have, if you're putting money, if you're lending to this bank, then, you are taking a risk, but they're using your money to lend out further, and you're expecting a profit, that kind of thing. Yeah. Yeah.
Mitchell has a bunch of stuff too.
Mitchell has a bunch of stuff. So Mitchell has a few questions. We'll talk about your first question first. How about if the post, or how do I parse this?
If the postal system.
Oh, okay.
Like if the postal system to service the accounts uses like the usually old building that postal services often are, like how if that, like do they accommodate?
How if the postal system to service the accounts is used, can the usually old building accommodate all the customer volume?
Right.
Yeah, so I mean, I think something important to keep in mind is that most banking is digital online right now. So you could have, so Fed accounts is very similar to the idea of postal banking, but it doesn't have to be. It doesn't have to be that, the post office is where you go in and get your money from. It could be,
a regular bank can have your account in it or something. Yeah,
or there could be Fed ATMs where you withdraw your money, that kind of thing. You're not getting loans out through this bank. Most of the time you go into the bank these days is if you're doing something more complicated than just withdrawing money or making an online payment or something like that. So I'm not worried that the post office buildings will be kind of run out of physical capacity or anything like that. It's mostly going to be online.
Could I suggest a counterpoint to that? Like maybe the people who would be most likely to first use a Fed account, who like don't currently have a bank account, would also be people who are more likely to like have cash they want to deposit in person, or like deal with people in person. I don't know. Yeah.
And then there's also the question of how do you get people enrolled in the first place, and I think there are some logistical hurdles there, and maybe Bethany's right that I shouldn't just be discounting that. But I think
if they have a postal account, they can go have an account based on someone's address or something.
Yeah. you can do that. That's hard for homeless people, but you could certainly.
They can have like by the beds in their homeless shelter or something like that.
Yeah. I mean, there's various kind of logistical challenges, but I think we can manage all of them. I don't think it's something that's going to take that many resources to implement.
Did you say by
in the grand
bed
scheme of
at
things.
the homeless shelter? Is that the address?
Yeah, are you in bed 2B or?
Oh, right.
Yeah.
Okay. On the grate outside the bank.
What?
You can have a deposit box too. I guess you could give people those, for free or something.
That's how in South Dakota, whatever, there was the law changed, and they weren't able to vote because they didn't recognize postal boxes.
Oh,
Yeah,
interesting.
that's disenfranchising huge numbers of indigenous folks on reservations.
Right. Oh, on reservations too. Right.
Yeah.
Right.
Wow.
That's really
Yeah,
interesting.
they were like, we're like coming to a super racist election. Spoiler is let's disenfranchise some brown people.
Right. Because a lot of people probably use the postal boxes, right? Yeah.
Yeah, and then like a lot of the reservations, like there aren't like federal street addresses.
Right.
So like they have post office
Right.
boxes. That's how it works.
Yeah.
So.
Yeah.
And they also, in third world countries, in like Latin America, they don't actually have addresses. They just say it's the third street off of the church or something, and all these random things.
Right.
Yeah, so there's certainly, if you wanted to implement something like this in another country, that would present some challenges that we might not even face here, or more so.
Or even more so,
But I don't think that means it's not worth doing. I mean, certainly we have banks, right, and that people use, and at the very least, you could have the central bank provide that service as well and compete with the banks. So the banks would have to do something above and beyond in order to get people. And maybe part of what they do is they find the people who, for whatever reason, weren't able to get on a Fed account or struggled to get on a Fed account or something like that. And that's part of how they make their money, by cleaning up what the Fed couldn't do or something like that. But I imagine that it wouldn't take long for everyone to kind of be able to get an account at the Fed.
Right. This kind of leads to Mitchell's next question, which is like,
Yeah.
what about the nitty gritty of, I guess, like what kind of services they would offer? Or like,
Yeah. So what would be the parameters and guiding rules for servicing accounts such as Fed accounts, employees' conditions, customer service, etc.? Yeah, I mean that's a good question. We'd have to certainly have more employees at the Fed who are overseeing this kind of stuff and managing it. But I think, in terms of the rules for the accounts themselves are very simple. At least in Morgan Rick's proposal, there's no fees, and there's no kind of overdraft protection. You're just not allowed to overdraft your account, I think, and it's just you're not gonna get loans from the Fed, that kind of stuff. It's just like a really straightforward checking account that's free.
Why do regular banks allow you to overdraft your account?
Allow you to what?
Why do they allow you to overdraft your account?
So they can get overdraft fees.
Like, I'm wondering if this might be a bit of a tangent, but I guess I was trying to think through in my mind, is this like a service that people want, where they would like the option to overdraft and pay a fee later, or is this like the kind of thing where like nobody wants that to happen because then they have to pay this big fee, but they forgot?
Well, I think it depends. I think some people want it. Some people, they really have to make a payment and
it's
they
like
don't want it to not
it's
go
like a
through.
payday loan kind of for some people, right?
It's a little bit like that, yeah. And then, the bank charges this fee for it. I know that in a lot of banks you can disable it. You can make it so that it doesn't do that. The default is on, and I think that's a combination between, banks kind of want to profit by default, and customers want to be able to make their payments by default. So I think there's kind of this default of assuming that it's something that everybody wants. Right. Of course, everybody hates how high the fees are. I know that my bank it's only like $9 or something, and I don't think I've ever gotten charged an overdraft fee by them, because I've overdrafted a couple times, but I think it's like you have to do it like twice, or the third time in a year or something. They'll charge a $9 fee, and it's a one-time fee. If you spend multiple times, and like if you buy like 10 things that are $5 each, it's not 10 fees, it's just one fee for the whole thing. So you guys should all.
But if you have multiple accounts, like at Bank of America, it will automatically take from an account that
right. So there's
has money in it.
Right. So
if you set that up,
that's another way of
anything.
right. So that's another form of overdraft protection, and that might be what Morgan Ricks is talking about, because you're not going to have a separate savings account at the Fed. You just have the one account.
Right.
So you can't like link it to another
Yeah.
account and have it automatically,
Right.
you know, come from your savings account or something like that.
Right.
Yeah.
Years ago, I needed an overdraft, which is technically a credit relationship.
Right. I was thinking that.
So all of a sudden, I owned a new credit card
Right.
and started to get credit card bills.
Yeah.
For the card I never knew I had, but they magically created when I
Interesting.
overdraft.
Yeah.
Makes
right.
sense.
Right.
Yeah.
That's interesting. Yeah, it's like credit.
Would Fed accounts banks be a good place for financial education classes? So I think there's a lot of emphasis on financial education these days. Like people need to learn more about how to manage their money, et cetera, et cetera. But I think the problem, the real underlying problem is that people are poor. It's not like you can teach them to manage their money better and then suddenly they won't be poor anymore. So I don't. Yeah, go ahead.
I think that's totally true, but I have something to add to it too.
Yeah, go
that
ahead.
you'll probably also like because it's sort of self-evident.
Do it.
But like even if you're not, like if you do have money, the way that you're supposed to like plan for retirement and stuff like this is sort of complicated because it's not
Right.
just like you have a basic income that pays out when you're retired. So like I think that's another factor. Like there's all these ways you could be quote unquote making more or less money off of your existing money, or like how
Right.
much should you be saving? And like I actually think it's not just that. Like, I think there's also a lot of like complexity for people who have money in terms of how they're supposed to handle it.
Yeah.
As soon as 401k started, really, I mean, when it stopped being pensions, people didn't have to pay attention to pensions.
Right.
It just happened. And they
Right.
stayed at the same company. But
Right.
once it got into 401ks and you could decide,
Right.
you know, which things to invest in, how much to invest. And this whole idea of, you know, well, people should be allowed to, you know, take charge of their own savings and not
Right.
have it taken out automatically and stuff, which is ridiculous because most people don't know how to do that. It's better to have somebody just take it out
Right.
on a
You have
regular
to
basis.
decide between all these different companies.
Yeah.
These companies charge fees
Right.
to manage your money.
Yeah, and it's complicated
It is.
if you don't understand how money
Right.
works.
And it's also
Yeah.
complicated to think about when to take out loans, when
Yeah.
is that worth it, when
Right.
to be saving for retirement, when is
Yeah.
that worth it, which
Right.
things to pay off, like
Yeah.
this or that.
Yeah.
Like it's
There's a
really
lot
complicated
involved.
even
So
when
I
you're not-
think it's a sign that there's a problem in our society if it's something that if this kind of like financial education is something that people need. In a well-functioning economy, money is something you just use and you have it and you don't have to think about it too much. We've made it a lot more complicated for people than it needs to be, and then some of it, like I was saying before, it's complicated and you might be able to help a little bit by teaching people all this stuff, but it's stuff that they shouldn't have to know in the first place. And even if they learn everything in the world, it doesn't solve all the problems.
In my high school, there was a financial management course or something like that,
Yeah,
and it was like mandatory, so I took it.
Interesting.
there you go.
So you could just have that.
Yeah, in schools. would be good.
Yeah. And Mitchell's pointing out, I think in response to the savings and loan discussion, interest rates changing in the late 80s was a factor in the bank issues too. So I think that's right. We had, I know in the early 80s we had very high interest rates, and then they started to come down in the mid 80s, and that could have led to over lending by some of these
you're saying,
institutions.
Yeah.
High interest rates, and high interest rates led to what? Sorry, I missed that.
Well, we had, so
Overlending?
we remember the stagflation in the 1970s. In order to get that under control, we had to bring interest rates up really high. We had to push them up really high, like double digits, 18%, maybe even higher.
Wow.
And then they started to come down in the mid 80s. But when interest rates are lower, that means people can lend more, right?
Okay.
Or people can borrow more. Like I can
Borrow
afford
more,
to
yeah.
borrow if the interest
Right.
rate is lower.
Right.
So there's going to be more lending because
Right.
more people
Okay.
can afford to borrow. Yeah.
Okay, got it.
Yeah. So Mitchell is talking about the post offices. They don't have offices for loans, and that's fine because you wouldn't be getting loans through these kinds of Fed accounts anyway. And that's an example of we still need a facility for loans in the economy, so we'd need other financial institutions. And then, yeah, it's still an interesting question to me how you how you get people to lend to those institutions so that those institutions can lend
Yeah.
into the economy. Yeah,
Right.
because right now when you have an account at a bank, you're lending to the bank.
Right.
Right.
So that they can then lend to other people.
Right.
Yep.
My understanding of poor people getting loans is that it doesn't happen. It doesn't make any sense. Because the banks aren't interested in doing any work on tiny loans.
Right.
But if you want a big loan, well, then the bank is not interested in giving a poor person with no collateral or prospects.
Yes.
Actually,
That's exactly
like
right.
in India, there's micro lending where they can lend out like $20 and things like that. So
Right.
but they charge like 30% interest.
All right. So then that's where like the payday lending comes in, like
yeah.
we're talking about. Yeah.
Yeah.
Right.
So, but I mean, yeah, I mean, like if they lend for profit, like Steve is saying, the banks lend for profit, and if there's a certain like fixed cost to putting a loan together that they have to pay, they're not going to lend anyone an amount of money that doesn't make up those fixed costs when the loan is paid back. So yeah.
So I sort of think that even in America, that there are no loans for poor people, and so they would only have basic income. It also means that in Fed,
But they can use
Fed
the
accounts
basic income
don't
as
do-
collateral for the loan.
Then maybe, yeah.
Yeah, I mean, once they have basic income, to the however big the basic income is, to that extent, they are less poor than they used to be.
they
so-
can save their basic income,
Yeah.
but they don't need a loan.
Right.
Right. Or they could potentially borrow against the basic income, but then that gets a little tricky because
They
It's
have
almost
started
really
shit
a
over
payday
there.
loan.
Right.
So
Right.
they're trying to avoid that.
Well, it depends on what your level is.
It depends on the
Income
level,
is.
yeah.
I mean, so like, if the basic income is like $60,000 a year, then they're like a marginally better like credit risk than I am,
Right.
right now.
Yeah.
But,
So then you
yeah, it
could get a
depends on the
mortgage or
level.
something.
And I think someone asked me on Twitter recently if I thought basic income would kill the payday loan industry, and I think it would certainly transform it. It would be less risky to lend to poor people, to poorer people on the poorer end of the spectrum. It would become less risky to lend to them, and it would be there would be perhaps less willingness of poorer people to pay higher interest rates as well, because they at least do have the basic income. So I would imagine that you'd see some convergence, depending on the size of the basic income. You'd see more convergence between payday lending and kind of traditional bank lending.
And also, a lot of people use a payday loan to pay off another payday loan. so it's like sort of like a transferring credit card amounts. And
Right.
they pay like 5% to transfer the amount that was on the card. And so it's so if you have a basic income, you can just pay off your loan.
Right.
And so
Yeah.
you don't have to incur the charges.
Right.
Yeah.
So I think that Fed accounts are simple. They don't give out any loans, but I don't think that poor people can get loans anyway. So
No, I see what your point is there. Yeah.
Yeah, I think that's right. But I don't think it would be only poor people using the Fed accounts. I think it's as a highly convenient, risk-free checking account, there is an incentive for other people to just
Right.
move their money over there.
But
Yeah.
oh, well, I was just gonna say though, like if they didn't have any interest really to them, and then like regular banks stepped in and had 1%, 2%, a lot of people would keep like a chunk of their money in the regular bank.
Regular banks
Maybe
would
not like the poorest people, but
regular banks would have to work to pull people's money away.
yeah,
Yeah.
exactly.
maybe what I'm thinking of is create Fed accounts and then at the same time say we're not going to bail out the banks that we bailed out the last time.
Exactly.
Right.
And I think that would make a lot of sense.
Right.
That's
Eliminate FDIC insurance too.
Yeah.
Yeah. So then not only would the regular banks have to pay higher interest, but they'd, in order to pull people away from the simple Fed accounts, but they'd also have to overcome the fact that they've got more risk. Putting your money in there is risky, so they'd have to pay even higher interest rates. And I know Morgan Ricks is proposing that the Fed pays everybody interest on, the equivalent of what is now interest on reserves, I would imagine, like I said, that it would have to be much lower in order to incentivize these other types of lending in the economy. Yeah, financial intermediation. Yeah.
But also, like, if you want people to have more money, then you could increase the basic income if you also had that tool.
Yeah. So Morgan Ricks, he doesn't talk about basic income.
Right. Yeah, he's talking about that. Yeah.
But if you want people to have more money, basic income is the way to go. Yeah. And he talks about paying interest on these Fed accounts as a way to kind of give people the money they deserve, but that doesn't really make sense for a few different reasons, because you're paying people for having money, so the people who have more money would make more money, and it's also that's not what the interest on reserves is for. Yeah. He also says something in his paper where I think I maybe started to mention this earlier, where he talks about the interest on reserves, that interest rate not transmitting into the market very well. And the way he frames it, and this is incorrect, his understanding of this does not seem to add up to me. So I'm going to explain what he said and then why I don't think it makes sense. So he said that the Fed pays interest on reserves to banks, and then banks don't in turn turn around and pay that same amount of interest to customers. But that's not the way that interest rate, that monetary policy is supposed to transmit interest rates.
So specifically, does he say that when interest rates go up, they are passed on to the customer, but when they go down, they're just
other way around.
Okay.
When they go up, the interest that we get doesn't go up, but when they go down, the interest that we get goes down.
Right.
And he says that as if that's a problem, or it's a problem in the transmission of monetary policy, but it's not, because that's not how monetary policy works. What we're trying to do is increase the interest rates at which banks are willing to lend out, not the interest rates at which they're willing to borrow. Right. That's the transmission mechanism for monetary policy. The Fed doesn't really care what interest rates the Fed is paying on its own borrowing. They don't care what the banks are paying on their own borrowing. They care what rate the banks are willing to lend at. And that does transmit. So I don't think there's that much of a problem there that needs to be solved. Yeah. Okay. You guys want to get to the podcast?
Yeah. Only an hour and 15 minutes.
Let's see if this works. Okay. I hope we have volume. Let's just find out.
We'll find out.
Hey everybody, it is Stacy and Cardiff. Welcome to The Indicator, where every day we tell you a short story about the economy.
Let me know if you want to
Listeners,
pause.
and also you, Stacy,
Yes.
I want you to pretend that there's a box right in front of you. And it's a gift, and you're opening that
Excited.
box.
Okay.
What's inside of it?
What's inside of
Listeners, you get a bank account at the Federal Reserve. Stacy, you get a bank account at the Fed. You get a bank account at the Fed.
Yeah.
Everybody gets a bank account at the Fed.
I'm trying so hard to match your level of excitement.
Well, also, I don't actually have the authority to give everybody a bank account at the Fed.
It's not even real?
But I will say that the proposal for everyone, individuals and small businesses, to get access to a simple checking account at the Fed is a serious one.
On today's show, we speak with the person who is proposing it and look at why he thinks it would be such a big benefit to us all. And Cardiff, I have to say, your Oprah impression is solid.
Solid, right?
Yeah.
Been working on it all morning, to be honest with you.
Must have been an interesting subway commute.
Yeah.
Did you get your own seat?
I got my own car.
That's a pun.
Nice. Yeah, it is. It is. Good.
Support for The Indicator and the following message come from The Future According to Now, a podcast from Fidelity Investments and Atlantic Rethink, exploring innovations that may soon change our lives and potential opportunities for investment. More at theatlantic.com/Fidelity Podcast.
So now our YouTube video has the ad in it. So that's
How banking actually works in this country and how it should work. So says Morgan Ricks.
I'm Morgan Ricks. I'm a law professor at Vanderbilt. But before that, I was at the Treasury Department and worked on banking policy there. And then even before that, I worked in finance and law, where I primarily focused on banking issues.
Morgan and a couple of other colleagues have recently proposed that all of us, you and me and other normal people, normal-ish people, should have the option of having a basic checking account with the Federal Reserve if we want it.
The Fed is in charge of monetary policy in this country, but it also functions as a kind of bank itself. It is called the central bank, and it is basically the bank of banks. Banks have to have a bank too. And the Fed offers deposit accounts and payment services to banks and financial institutions throughout the country. And Morgan's idea is that these basic banking services should be available to everyone, to the public, not just to banks.
This idea, he says, would solve at least two problems that directly affect a lot of people. First, not everyone has easy access to a bank account.
So in the U.S., we have an unbanked population that's about 7% of all households.
7%. That is almost 9 million U.S. households with no bank account. And these tend to be low-income households. Part of the reason that banks turn away these customers is that they consider them to be unprofitable. People without bank accounts face all kinds of problems.
You know, what do you do when you get a paycheck? You need to convert it into cash, which means you're probably going to a check cashing outlet of some sort, and they're generally charging, call it 2% off the top. So you're paying a haircut on all your earned income. And your income's probably not that high to begin with, by the way, if you don't have a bank account. So this ends up being a lot of money for the people involved. Say you want to just pay routine bills. You may need to go stand in line at a bill pay center to pay a utility bill as opposed to doing what the rest of us do, for the most part, at least more affluent people, which is to use convenient online bill pay. So there's a lot of actual fees and costs. There's time and inconvenience costs associated with not having a bank account.
Yeah, it's like an example of how it's more expensive to be poor. You know what I mean?
There's no doubt about that. And it's also a problem for everyone else because it's easier for us all, businesses and individuals, to transact with people who have bank accounts.
Yeah, so I think this is basically right. It would solve this problem.
So I guess that, just as a side note, you'd want the Fed accounts to do like some of the bill paying services and other things that the bank accounts do.
Yeah, you should be able to make payments using your Fed account, have a debit card and, all that kind of stuff.
Right.
The basic payments and
Basics.
Yeah. I guess because it's a checking account,
you can write checks, I guess.
Maybe you wouldn't write checks, but you'd have the equivalent of what we do now instead of writing checks, which is debit cards and online payments and stuff like that.
Maybe like the M-Pesa type thing with Kenya, maybe?
I mostly just meant like debit cards and online banking services, that kind of thing. Yeah. I think the M-Pesa thing is not something that's necessary in this country because we have even the people who are poor.
But in Japan, they have a thing like M-Pesa with their telephone.
What's it called? M-Pesos?
And in China, they have something like that too.
Okay. Well, there are apps. You're talking about just SMS payments, though.
Mm-hmm.
Yeah. I don't think that's specifically what he's talking about, but that could be something.
That's pretty much what M-Pesa is, though.
Yeah, it's SMS payments.
Mm-hmm.
Yeah.
I wonder if this doesn't happen, do you think some of the other services like PayPal or Venmo will just sort of become bank accounts? What will step in to or will nothing step in?
Well, it's hard to
Step in, why?
Kind of for the people who don't have a bank account now. I'm wondering.
Yeah, because PayPal can be used as a bank account very
yeah.
easily. Yeah.
It's hard to,
And
it's
they
hard
have
to
debit cards.
get a PayPal account if you don't have a bank account, isn't it?
Oh, really?
Is it?
Well, I know initially when they first launched, all you had to do was have an email, but you couldn't withdraw money or add money to
my
it.
brother's bank, he has Citizens Bank. He takes a picture of his check, and then it automatic, and then he sends it to the bank.
Yeah.
And so, couldn't you just do something like that with
I guess
PayPal?
that's what I was wondering, if they would start to do that kind
But I
of
think Alex read that
Yeah.
currently,
You can't,
PayPal and Venmo spending is linked to your
bank account, yeah.
And
account.
the
That's a way to sort of make sure that you're good for it.
Right.
and you have to provide identity verification, just like setting up a bank account too. I think at this point, yeah. So, technologically, it's possible to have an online account that you never withdraw money from or add money to. You only get get payments through that system and send payments to other people who have PayPal or whatever it is. That's possible.
I guess I was thinking like they don't make their money in quite the same way, so maybe they'd have more of an incentive to make changes to it.
Yeah, that's true. I guess they make their money more on transaction fees than on.
Right, exactly.
I don't think PayPal does loans or
Right.
anything like that, or mortgages.
Right.
Yeah.
I don't know. Anyway, just
Yeah, it's an interesting
They do have
thought.
cards though now, debit cards.
They do and credit cards.
really.
Yeah.
Oh yeah, they've been sending
And
emails
there's a whole
about that.
business aspect. You can get a business card.
Right.
Yeah.
And there may be loans involved in
Huh.
that too for businesses.
Interesting.
There's a whole new.
It's possible. They're very bank-like,
Yeah.
and this is actually something we see happen a lot. Like institutions that are not banks become more and more like banks, especially as banks get regulated. Then other institutions come in and do the things that the banks used to do but aren't allowed to do anymore, that kind of thing. But you know, we saw with savings and loans, they became more and more like regular banks. And by the time, you know, in the 1980s, they were just kind of like another kind of bank.
Right.
And you see that with
And then regular banks became more like they bought like stocks and things. And
yes, so there's been some of that, especially with like the deregulation in the 1980s. Banks started to look like other non-bank financial institutions and vice versa. Money market funds, you know, it used to be that banks were not allowed to pay interest on their checking accounts. And then money market mutual funds came along, and they were just like, if you had an account there, it was very similar to a deposit account at a bank, except it paid interest. But since they weren't a bank, they weren't affected by the regulations, and then eventually they ended that rule, and now anyone could pay interest. But yeah, it's very interesting how, you know, kind of the economy needs certain financial services, and depending on what the regulations are, they kind of take different forms from different institutions and that kind of thing.
I guess it's a little bit where my thinking was going. Like, there's clearly a need for this service. I don't know if there's any like
The service of
profit to be made, but
having a deposit account.
yeah, for people who don't. So
Yeah. So how could we get it there? How could
Or
we
like-
get it to people if we don't have Fed accounts?
like, what would not maybe naturally, like, what company or whatever would maybe like naturally fill that role at some point?
Gresham.
Well, other than Gresham,
Yeah.
I don't know. Maybe nothing. I mean, obviously it's gone on this long, so
Yeah, I mean, it's gone on this long, but you know, over time, more and more people get bank accounts.
Right.
It's a matter of degree as well.
right, that's true.
Yeah, it's an interesting question. If something could kind of come along and just fix this problem.
I saw just
yeah.
like a snippet of a news thing about like Facebook getting into like currency transfers across
Facebook.
countries and stuff.
Yes, they now have Facebook payments and stuff like that. Yeah.
Oh
So-
yeah, you can buy gifts. Or is that gone away? I don't know. That was a transaction they had for a while.
The gifts thing, I think, is gone.
Yeah, I think
but you can
so.
send money
Yeah,
on
you
Facebook
can,
now.
Yeah, I guess
Yeah.
you can send it across countries.
Yeah.
You know,
they have their own
opening
cryptocurrency too.
I think that was
Yeah,
what this was about. Yeah.
opening a bank account. I mean, kids can open a bank account. Anybody really can.
Ooh.
Right? So
Depends what kids you're talking about.
You have
If
to
their
have a
parents have
parent.
bank accounts and they open an account for their kid, I mean, like, if you're just a homeless kid or something, and
You have to have a
you're
parent,
an orphan
yeah.
and
Okay,
whatever,
so,
I mean, like,
so it's minors, but they're depending on the parents. So
Right,
I'm just
rich
thinking
kids can
about
open bank accounts, yeah.
What is the requirement?
That's
For a
like
bank
a
account.
barrier to people. You mean? Yeah. It's a good
well,
question.
a lot of it is identity documentation, stuff like that. A lot of them have minimum deposits, so if you don't have enough money to put in there, you can't open a bank account. There are some that don't have minimum deposit requirements, but it still can be logistically tricky if you don't have the right documentation, or you don't have an address, or
I guess that raises the question of like, would a Fed account be better for these kinds of problems? Because maybe they would also require. I don't know what they would require.
It's a good question. Because then, like, a lot of this is, if it's because of regulations, then of course the regulations would apply to Fed accounts too.
Or I don't know if they include in those households like people who are undocumented or not, but like they wouldn't necessarily
question,
have
too.
an account
Yeah.
at the Fed, right? So
You just have the postal thing, like I was talking about. Your house is your bank account or whatever.
Yeah.
Right.
Yeah.
But then we still circle back to the like
Yeah,
people who are
right.
homeless, like
Yeah.
you know, if people only have PO boxes, if they're like on a
I think-
reservation or something,
Yeah.
like how do
Yeah.
you handle that?
Right.
And I think for a lot of people, it's the convenience too. And if you're poor and you have a bank account, a lot of times you're paying these overdraft fees all the time and stuff like that. So it ends
Right.
up being more expensive than not having a bank account.
Well, that part makes sense.
Yeah.
But just having a place to put your money. I mean, when we were in college, we always used fake addresses to do stuff. I mean, there's nothing preventing.
The extent
Yeah.
to which you can do
You
that
don't need-
Has
today.
changed.
It's a lot
Yeah.
harder to do that now.
Is it? You
Oh
think?
yeah,
Yeah,
definitely.
because everything's electronic. Like back then, you could be like, "Oh yeah, I live wherever," and they're like, "Well, okay, like
Right. Bring in a
some-
piece of mail to show it,
Like,
and then you get one.
Yeah, and they're like, all right, maybe like some intern next month is gonna like check this against a census record or something.
Right.
But now it's like
Really
okay,
quick.
like okay,
It's
like,
automatic.
It's
yeah,
a
we're gonna
quick
check this
verification.
like okay, we want your social security number. We're gonna look you up and be like, okay, we don't have any record.
And they'll ask you
Yeah,
like,
social
did you ever live like among
Right.
these addresses? Which
Right.
one did you
Right,
live
yeah,
at?
I
And you know, like
remember
that
that.
kind of
Yeah,
thing
yeah,
because
that's
they
one
they
of the-
know who you are
Right.
and where you've lived
Right.
and
It does
all of
ask
that.
a lot of creepy questions on you.
Right.
Right.
Yes.
Social
And if you
Security
can't
is the big one,
answer
though.
those
Yeah.
questions, you
Yeah.
can't get a bank account, right?
Right. But
Or maybe
social-
you can, but it's a lot harder, and you know that kind of stuff.
If
Yeah.
you have a social security number and you're homeless, I don't know that you couldn't though get a bank account. I mean, I'm just wondering what is the absolute bare minimum.
Yeah, it's a good question, right? What are the
Yeah.
barriers?
I think it's more of a continuum. I don't know if there's like an absolute cutoff point
Oh,
where.
in India they have biometric,
Oh yeah.
and they have like bank accounts for that, I think.
Yeah.
And that's how they plan on issuing a basic income like Sakim with that.
Right. Yeah. So I mean, I think you could any person you find anywhere, if you had the time and the resources and the will to get that person a bank account, you probably could. It's just a matter of there are obstacles and barriers, and you know, for some people or for anyone who's unbanked, it is not worth it for them to figure it out.
I have a.
And that's partly because they're not, you know, it's not like they're going to have that much money anyway. They're not
Right.
saving any money. Like,
right. And
like
the
any money they
figuring
get,
out
they're gonna have to
part is
spend anyway.
important, And that's
Yeah.
true for a lot of things that
And-
people could get, but they don't apply for because there are a lot of obstacles to
and
the forms.
a lot of times people who are poor are working a lot more.
Right.
So they, you know, the banks are not open
And you
during the
usually have
day.
to go
and-
in person to. Yeah, you can't
Yeah.
do it
Yeah,
online.
from
yeah.
like 9 to 5.
Right.
Monday through
Yeah.
Friday.
Yeah. Right.
But, you know, it would be an interesting exercise to, you know, I wonder if there's any nonprofits or anything that go around trying to help unbanked people get bank
Yeah,
accounts.
right.
Probably there are.
Yeah, there's
Yeah,
a whole middle layer of people who help people who want disability, for example. That's
Right.
their job.
Oh,
To
well,
be
that's
advocates.
because it's profitable.
Yeah, it's profitable.
Yeah,
Well,
if you no, it
that's
is.
a government thing. I mean, no.
No. So if you get denied disability and then you get disability later, you get all the back pay
Right,
from all the disability
right,
you should have gotten.
right.
So that means there are plenty of lawyers
Well,
out there
lawyers-
who want to take a cut.
But I'm not talking about them. I'm talking about their
Mhm.
advocates
Like the
that are part of the
federal
office who
poverty
get
center.
assigned to you and to help facilitate people who can't fill out the forms. They don't understand what they're doing.
Yeah.
And they come to your house and they help you do that.
Right.
And they're not getting any money for that. I mean, except for the job that they have as part of the office of disability.
Sure.
I actually volunteered it.
So-
it's like
They're not
Oh,
lawyers.
really?
So.
That's cool.
They
So
don't
so
charge
you're
anything for those.
My
So your
point is
point-
that
yeah.
there could be people associated with the Fed, let's say, or with banks who do that for people. And maybe there are now, for all I
Right.
know.
Probably.
Right.
There may be people like that help banks
well,
reach
so
out to people.
so I guess a big issue here is that for a regular commercial bank, it's not profitable to
Right, right.
give a bank account to a poor
Right.
person
Right,
because that's not going to help you in your banking activities, making a profit, that kind of thing.
right.
So there's different incentives. If you have Fed accounts, and the Fed is, you know, their goal is not to profit, but to help the citizens and the people of the United States.
Right.
Um,
Then
so
there could
then
be that
you're right. I think
department of
They do
people
that
who do
more.
that.
it
Yeah.
makes sense.
Yeah.
It makes sense that they would do that.
Yeah.
It doesn't make sense that a
Regular
for-profit
bank.
commercial
Right.
bank would
Yeah.
ever do that.
Yeah.
Yeah. Yeah. Unless there's like some really, really rich person who doesn't know how to fill out a form or something like
Mr.
that.
Burns. Yeah.
Yeah. Right. Exactly.
Come back.
Yeah. Yeah.
I'm sure in the early days of banking, when wealthy people didn't have bank accounts, there were people who would have.
Yes, let me show you what we can do with your money.
Exactly.
Yeah, I mean, like financial planners do that.
Yeah,
that kind of thing.
definitely.
But they're not going to try to sell to someone who doesn't have any money.
It's kind of an important question, though, that you raised, Joan, because like unless we understand specifically what the barriers are, like we don't necessarily know whether a Fed account is going to address those barriers or not address those barriers, and maybe it depends on some of the details of like.
Right.
Well, maybe I don't know. We haven't really listened to it. maybe he brings it up. I don't know.
Let's listen more. I think he's going to start talking about
like one of those people trying to get out the vote or whatever.
Right.
Yes.
Exactly.
Yeah.
Yeah. But for bank accounts. Yeah.
All right, let's listen more to the podcast, and let me know anytime you want to pause and comment on anything.
You have to deposit, then have to cut a physical check. But if you don't have a bank account, then you need to cut a check.
So if everyone had access to a bank account at the Fed, the first problem it would solve is that simply more people would have a bank account.
The second problem it would solve, Morgan says, is that even those of us who do have bank accounts would stop getting kind of ripped off on those accounts. Think about it this way. As Stacey mentioned, the Federal Reserve is in charge of monetary policy, which means that it moves interest rates up or down depending on how the economy is doing. And one of the ways that the Fed changes interest rates in the whole economy is by changing the interest rates that it pays to the banks that have accounts with the Fed.
So, for example, the Fed has raised interest rates from 0 to about 2% in the past few years. So banks that have a deposit account with the Fed are getting almost 2% interest on their deposits. So in theory, the banks should pass on these new exciting interest rates to their customers.
But
No, that is not correct. There's no theory that says they should do that. Right. We already talked about this.
Yeah, we
but,
did.
Yeah.
But why is the interest rate raised in the first place? For the banks?
Because they want to reduce the amount of lending that the banks do.
Right. So then the banks.
So if the bank's getting paid, do you want to say?
Yeah, I mean, just if the bank is getting 2% at the Fed, where it's really safe,
Right.
they're not going to lend to you or me for anything
They
less
wanna
than
reduce the
2%.
lending, that's
So
the
now they're
monetary
gonna,
control
yeah,
part
they
of
might
it.
rent
Okay.
2.5%, but then
Yeah.
maybe I don't want to pay 2.5%.
Right.
So now there's less.
Okay.
Yeah.
Right.
that
They don't
makes
care what the
Yeah.
banks are paying the
Yeah,
customers. And honestly, it doesn't really matter that much for monetary policy. It doesn't matter really at all. There's no
Right,
amount
right.
that of interest that people should be earning in their
Right,
checking
right,
accounts.
right.
So Mitchell says Operation Hope is a nonprofit that helps inform you about credit, including score/reports, education, housing. They are sometimes located in banks because they bring more qualified clients.
Interesting.
Yeah, so I guess this is related to financial education
Yeah.
too. Like if people don't know how to get a bank account, then it sometimes feels not worth it. Like,
Yeah.
I mean, like there's certainly been times when there's some kind of like thing that I probably should do that I don't know how to do. Maybe it's related to health insurance or something like that, and I just
Yeah, maybe it is.
never get around to doing it. I've
I
never
know.
been. I'm not poor per se, but it's these things are they create like a mental burden, and people
Yeah.
don't want to have to worry about it.
Yeah,
Like
absolutely.
you've never had a bank account, and you don't know what's involved in that or how to use it or anything like that.
Could take
Like, are you
half
really?
a day. Could take up more than half a day.
Yeah,
Every time.
yeah. So, I mean, this is another example of why, why our economy is broken in some ways, and it causes this need for education, because it just there are things, and it's not just bank accounts. There are other things that are just really complicated for people to figure out that don't need to be that complicated. Yeah. Okay. Let's keep listening.
On those rates. No. Stacey, I actually looked up how much of an interest rate I was getting paid on my account at Chase.
Oh, yeah.
Yeah, my savings account, you want to know what I was getting paid?
Yeah.
0.01%. On my checking account, it rounds down to 0.00%.
Wait, but pause.
0.0%?
This is not really that relevant, but money markets or whatever, those things are paying about 2% now. And that's, my mom, is that related to like the interest rates that the banks are getting at their, how is that?
It's related. They're going to pay a little bit of a higher rate though, because that's just kind of the way they're set up. They're not quite as convenient as checking accounts, and they invest in I guess bonds and stuff.
I think there might be a penalty for withdrawing too many times.
Yeah,
from
Yeah.
that account.
You can mine.
Yeah.
You can only do 6 times a month or something.
Yeah, and maybe even that's more than.
Right.
Yeah,
Yeah.
it might be less, but it's some amount of times.
Yeah.
Yeah.
So there's
Right.
a restriction there.
So you'd expect them to pay higher interest rates to get some people to put their money in there,
Right.
kind of like what we were talking about before. But it is related. If they paid 10% or something, then banks might want to lure some of that money back,
Right.
that kind of thing. It's interesting that there's not that much competition between banks on paying interest rates on checking accounts.
Yeah.
Yeah.
Well, except now there has been more, or at least with these and like some regular bank saving accounts have also gone up. I was researching this
Yeah.
with my mom. But
Yeah.
generally, it seems like that's not what people are actually like using the bank account.
I go actually
Yeah.
say that
Yeah.
next in the article.
Oh, do
Yeah.
they? Interesting.
Yeah, but I mean, like intuitively, it feels like there's almost even a moral hazard there. Like banks will just keep, kind of increasing the interest rates, and they know it's backed by federal deposit insurance. So even if they're
Right.
investing in risky things to be able to pay those interest rates,
So why
then-
don't they just do that?
so,
Yeah,
yeah,
that's
like-
a good question.
Yeah,
Yeah.
It
but
also could be, if you're a conspiracy theorist, that they're conspiring with each other to keep their interest rates low. They
yeah,
don't have to compete.
yeah.
Anti-collusion,
So I don't think they're doing that per se. But I think Richard, you're right that that's not really what people are using checking accounts for. If people want to earn interest, they're investing in some other asset. So the interest on checking accounts is
Right.
not
Although,
very-
like,
yeah.
again, if they want your money at all, like, I just moved most of mine, last year or whatever, into this other account now, and it seems like my mom does that too. Like,
Yeah. So I mean, so I guess the question we could ask is, why do people keep so much of their money in these accounts if they aren't earning very much interest?
right, and there are these other options.
Yeah. So, but the fact that fact that people are willing to do that means there isn't much of an incentive for banks to increase the amount of interest they pay.
But I wonder if it's a
Yeah.
gradual thing that's changing. Like, I don't know how long
It could be.
money market things have been around, and like, I think they are insured now. I don't know how long that was true.
Yeah, money markets have been around for a while, since what, the 60s?
Oh, then I don't know.
Yeah. The first,
Just imagine that you guys get a joint account. It starts sweating. Alex, the FBI is out town.
Yeah, right. Yeah, exactly.
Bizarre.
They want to know what these Gresham funds are.
yeah, right.
It's tracking.
Yeah, I think the very first money market mutual fund actually, it failed during the 2008 crisis.
Interesting.
I think they were invested in some assets that went bad, and their shares, they don't call them deposits, they call them shares, started being worth less than $1. And yeah, I think they had to shut down as a result of that. Yeah. Yeah. Okay. More podcast. You guys ready?
Yep.
Yes.
So it's 0.
It rounds down to 0. At least to the second,
So it's
to
zero.
the second number after the decimal. It rounds down. It might be, for all I know, 0.0049. All right, I don't know.
Well, all I know is that my Wells Fargo account, I get like 15 cents every 2 years or something. I'm like, what is this? I'm like,
Excellent.
interest, great. Thanks, guys.
This is a little bit odd because you would think that the banks would be competing for our deposits.
That's
So
true.
if my bank is not raising rates, I have the option of going to one that does. So all the banks, in theory again, should be raising rates to compete for my money. That obviously does not happen.
And Morgan says it's a bit of a mystery as to why this doesn't happen.
Yeah.
I mean, it could just be that people do not pay enough attention to the interest rates on their bank accounts. But Morgan also did notice something else when he was looking into this that he found kind of curious.
When the Federal Reserve raises interest rates, banks are really slow to raise the rates they're paying on deposits. But in the other direction, when the Federal Reserve lowers interest rates, banks immediately cut the interest rate they're paying on deposits.
In other words, banks will pass their interest rates on to their customers when it's convenient for them, the banks, when it means they can pay lower rates. It's not when it means they can pay high.
So can I just say that, banks should be doing what's convenient for them and what's profitable for them. That should be what's expected. Yeah, that should be
But
obvious.
also,
Yeah.
do you have a sense of like why when the interest rates go down?
Well, I think by default, banks always want to pay as little as possible. When the interest rates go down, everyone's getting squeezed at once. So it makes sense that they would kind of lower them right away. When the interest rates go up, it makes sense that there would be a more gradual process because banks on their own, they don't want to raise interest rates, so there'd have to be something else going on to incentivize the raising of the interest rates somewhere else, and then it would kind of like gradually come
So
back
is the
up.
idea that if like all the banks are getting squeezed, they can anticipate that the other banks will also lower theirs, and so they can kind of get away with it as well.
Yes.
Yeah.
And when the rates go up, all the banks know that the other banks are not going to raise their rates unless they have to.
Right.
Which
so
is always
more
gonna
of
be
a
the
gradual
case.
competition thing.
Right. They lower their rates kind of because they have to.
Yeah.
And then they only raise their rates when they have to too. And the rates that get paid to them increasing doesn't mean that they have to raise their rates right away.
Right.
Yeah.
And they lower them because they have to. Why do you think they have to?
Well, because they're earning a certain margin on on what they lend out. So if the rate that they can lend out has gone down, then that collapses the margin. So they lower the rates to get some of that back again.
Have to do that.
Yeah.
Okay.
So I think it's not that mysterious.
Right.
Yeah.
It's not like they all decide, oh, good, now we're going to lower ours,
Right.
but we're not going to raise ours.
Exactly.
Yeah.
Okay.
Yeah. I mean, there's probably more to it than that, and I can imagine that. Maybe there is kind of a little bit of this competitive effect, but not very much of it. So it's kind of gradual or that kind of thing on the way back up. Yeah.
Yeah, it's not like what's advertised, just as a sort of side note in terms of like whether people are paying attention. Usually banks don't advertise the checking account, especially the interest rate on the checking account. It's usually like whether there's fees, they'll give you some signing bonus or something. But
Well, on
not
savings
usually.
accounts they do, though.
They do a little bit with savings, yeah.
Okay, more podcast.
Yeah.
Okay.
Or it means they can pay higher rates.
This is so infuriating.
Is it really?
Well, if we all had bank accounts at the Fed, we would be getting the same rates as the banks. Not only that, but when it comes to simple
They
payments,
could have
money
different bank
transfers,
accounts for the
Morgan
banks
said-
still.
You could. I think the proposal is that everyone that they just expand the facility to businesses and people and stuff.
I see.
But the idea that you'd be getting the same rates as the banks, I mean, yes, but that rate would
Maybe
likely
go way
be
down.
much lower.
Right.
If you wanted to, yeah.
We talked about this, I guess.
Yeah.
But
All right.
let's hear some more because
Yeah.
we might be able to get through it all.
Service would be better. Right now, paying for something with a check takes a few days to clear, and even transferring money electronically takes at least until the end of the day. Guess how it works for accounts at the Fed?
I'm guessing my blood pressure's about to go up.
This is another big perk of these bank accounts that banks can hold with the Fed is that there's no delays in clearing. It's called real-time gross settlement. That's what central bankers call it. And it really is real-time.
So it's slow for the rest of us, and for them, it's instantaneous. For the banks, it's instantaneous.
Yeah, that's right. They have instantaneous payment in real time, and that's great. It's super efficient.
Is there any reason that they're missing that they do it instantaneously for the banks at the Fed, and they wouldn't want to do that for everybody or something like that?
So you're asking why it doesn't work that way for ordinary banks, and is there a good reason that's beneficial to society or something?
Or to the banks or whatever.
Or to the banks. I think for the banks, it allows them to be more flexible. So they can kind of settle everything at the end of the day, and that's kind of efficient for the banks. And this is an interesting question. Actually, when he talks about this, it makes me wonder if you had all this kind of real-time settlement on everybody's payments everywhere, then would you have a situation where the system gets overloaded, or you could have like a denial of service attack where people are sending like really tiny payments to each other and settling them all at once or something like that. It strikes me that it's pretty safe if it's all banks that are Fed members and they know what they're only sending payments when they actually need to clear, with each other and stuff like that, and reconcile at the end of the day. You're not going to have too many payments. So, and then this is also a question I have about transaction fees. If you have no transaction fees, then it's free to kind of spam the payment network with as many transactions as you want. And there's no transaction fees for the banks settling at the Fed, but that's a very small, restricted subset of responsible users and that kind of thing.
Right.
Yeah, the responsible user part is makes sense too, because individuals, it's not like they're checking on everybody, so it takes a long time to process, but some checking probably goes on, some kind of touching some points in that process.
Yeah. And it's also for the private banking system. I know I have multiple accounts at my bank, and if I'm transferring money between those accounts, that's instantaneous.
Right. Yeah. Right.
But in terms of making payments, if I make a payment to someone else who has an account at that bank, that could be instantaneous too. I'm not even sure. I'm not sure. Yeah, and there are certain things that are happening faster and faster than they used to happen. Like PayPal used to take 3 or 5 days to withdraw, and now it's the next day. Or if you're attached to a credit card, you can get it instantaneously and for a fee. You got to pay. Yeah. But it's not clear to me that we aren't already moving in that direction. And I guess the question is, why hasn't it already become instantaneous? I can't think of any benefit beyond just the protection against spamming the network, that kind of thing.
Right.
If you want to charge,
maybe it's like an antiquated sort of thing. We've always done it this way, so we're going to have all these different layers of checking all these accounts.
Yeah.
To verify how much, if the money's there, and it has this. We're the vice president of transfers, and we have to have it verified by all these other vice presidents of transfers.
Right, and I think at one point that it might have been that way.
I think it's probably not verified by vice presidents of transfers, but I can imagine
automated transfer checking.
So I could imagine that you have a payment network, right?
Yeah.
And then you have a lot of banks on this payment network, and then they all have to kind of share the same protocol. They all have to follow the same rules. Maybe 99.9% of the banks could do it instantaneously, but then there's a few rural banks or whatever that actually do kind of have to settle it at the end of the day or figure it out. And since they're all the banks are on the same protocol, on the same payment network, then they all have to go at that speed or something like that. So that's something I could imagine from a technology standpoint.
Right.
Yeah.
Which would not necessarily be fixed by Fed accounts if they were still trying to clear with other banks on that network.
Yes, but if everyone had a Fed account, you could make a payment
within
to that person's Fed account. Instantaneously.
All part of the same bank.
Yeah, exactly.
Listen to the last few minutes.
Let's listen to the last few minutes.
We're almost there.
I had no idea this was going to take this long.
Super cheap, super convenient.
Just super. Morgan says that this would take some time to set up for things like ATMs or people to deal directly with the customer. But he says that actually some of the necessary infrastructure is already in place because the Fed does already deal with trillions of dollars of deposits, just for banks, not for the rest of us. And branches of the post office, for example, could be used as physical locations if someone wants to withdraw money, cash, or speak with a representative.
But Morgan also emphasizes that the Fed would not be taking over most of the things that banks do. For instance, it would not be lending money to businesses, or giving people mortgages, or offering financial planning. It would just be offering a simple checking account or payment services, and those things are mostly moving online anyway. For now, this idea of having bank accounts at the Fed for real folks is just a proposal. It's an idea that, if nothing else though, highlights a few of the aggravating problems associated with this country's banking system, and it also tries to bridge the gap between what consumer banking is right now and what it could be.
This podcast is produced by Sally Helm and Constanza Gallardo. If you want...
Made it through.
I hadn't really thought about that. No other banking services. Being able to get loans from banks or get counseling from banks. So where would that all go? That would be another layer that would be set up.
So there's still a need for that.
Yeah.
And the question is, what would the remaining commercial banks look like once most people had Fed accounts, or what kind of financial institutions would there be, that kind of thing?
What is a savings and loan bank anyway? You talked about that. What is that? Savings and loan.
It's like a credit union, pretty much.
Okay.
Yeah, and I think they did more of the mortgages, that type of stuff. Is that right? Yeah. But by the end, they were just union. Like banks that had slightly different rules.
Right.
I mean, I think they still technically exist. We just don't think of them as really different from banks. Yeah. Okay, so we're getting to the end. Final thoughts about Fed accounts?
Well, I feel like I learned a lot about them. I guess some of the biggest outstanding questions I have are things like, what would happen to like the loans, and how would the banks have enough reserves and stuff like that? But it doesn't seem like it'd be that hard to kind of set up monetary policy so that they did. Probably people's like savings could be sort of incentivized to be in the regular banks, and then their like day-to-day checking could be in the Fed accounts. So it kind of still seems like a decent idea, unless there's something I'm not thinking about.
Yeah, I agree. I learned more than I wanted to learn. This is not a subject I would ordinarily go toward, but since Alex says, I did. But I think it's useful to know this stuff, or try to know it. But maybe the leftover banks could be these kind of satellite facilities for the loans and the other services that people want through banks. Yeah. Okay.
I also learned a lot. And I wonder if, we started open this talking about like basic income, and so I wonder if having the basic income going to their Fed accounts and then letting people just kind of sort around, okay, do they want to transfer all their stuff? Do they want to keep it in private banks? Like, if the messaging is really clear about like, okay, the Fed accounts are not going to offer you like, home ownership loans and that kind of stuff, so that people can sort and can maybe be like, okay, well, I'm probably not going to, try to get a mortgage anytime soon, if ever, and so I might as well just move all my money into this one single account that has like lower fees or better interest rate or whatever, and then other people might be like, okay, cool, whatever, I guess it's like basic income in this account, but like I'm going to keep my like $2 million in this other private account where I can do all of my other like, financial transactions.
Bill Gates forgets he even has the basic income in the Fed account. It just
like whatever, I'll just like add that to the checklist for my financial planner, and they can tell me if I need to do anything.
Exactly.
The simplicity is good.
Yeah.
Attractive. Yeah.
Good point about basic income.
Well, you can have it like, if you have an email that you multiple email accounts, you could automatically have your email from one account sent to another one. And so that could be like money, Fed account sent to your regular account or something like that. And credit unions. When I was at the University of Wisconsin, they actually had a university credit union, and if you went to that school, you could go to that. And the companies like in Connecticut, in Groton, they're this massive company of all these like military contracts. Electric Boat had their own credit union and they had like thousands of employees.
Interesting.
Let's see. Banks are not interested in poor people. So between Fed accounts and basic income, poor people can get a certain minimum of banking, despite banks not having any interest.
Yeah. That's a really good point.
Yeah, good point. Yeah.
So Mitchell says he has a couple points that he brought up here. He says the last part is like gas stations, they lower slower than they raise. So when the price of oil increases, the gas prices go up. And then when it decreases, they still want to charge as much as possible, but it might come down gradually. And I think that you're seeing the same effect with the interest rates on checking accounts. And then he says, I've read and heard what Richard was saying about systems being created a while ago being antiquated. Right. If I remember, one case had something on dial-up from years ago.
Interesting. In terms of how they're doing things now, like the inertia.
Yeah, I mean, if you have a system in place that works, you kind of need something to incentivize you to change it. That's generally true.
Yeah.
And yeah, I mean, I think I guess I'll bring up a new point as our final thing, which is that most of the lending and borrowing in the economy is not through commercial banks. It's through these other financial institutions. We call it the shadow banking system.
I only know that from money and banking. It's classic.
It's in there's lending in capital markets, issuing of bonds, money market funding of that, and that's where most of the money is. But the commercial banks still provide an important linkage between kind of the base money in the system and most of the money that's being transacted, which are instruments that are kind of derivatives of the base money, that kind of thing, or their loans and bonds and stuff that are denominated in dollars and ultimately kind of trace back to being like an IOU for dollars, but they're not the base money. Right. So the question is less about how is lending going to work in the economy, because it's probably going to stay the same even when people have Fed accounts. The question is, what's going to provide the linkage between the base money in people's checking accounts, et cetera, and the lending that's happening in kind of the greater financial sector? Because that's what we're fundamentally changing when we change the nature of checking accounts in commercial banks.
We didn't talk about
So that's my
dropped a bomb at the end.
kind of like
and now it's over.
We don't get to respond.
But it's something to think about. It's not really a different question. It's just a matter of like, we're not talking about changing the way loans are done. We're changing, kind of swapping out that connective tissue there.
Right.
Yeah.
Interesting.
Next week we're going to be on Tuesday because Bethany and I want to watch the presidential debate on Wednesday and Thursday. Andrew Yang is on Thursday.
Andrew Yang
tune
is
in
on when?
Thursday. Yeah.
Oh, Thursday.
He's on with Joe Biden and Bernie Sanders.
Interesting.
And Pete Buttigieg is in that one also.
Yeah.
And I think Kamala Harris is in that one as well.
Good.
And then Wednesday is Elizabeth Warren and a bunch of other people. So we're going to be on Tuesday next week, and we're talking about education.
Oh, okay, great.
Which is a subject that comes up a lot here. So thanks, everybody.
Thanks, Alex.